your finger in so many different advanced technologies. As I said, SpaceX.
Relationships with people, he said.
It's a strategy and an investment decision.
Most people think debt is a trap. They imagine credit cards spiraling out of control, loans drowning families, and interest piling up like snow in a blizzard. And yes, debt can destroy lives when used recklessly. But here's the secret the wealthy know, and almost no one else does. Debt is a tool, a lever that, when used correctly, can multiply your wealth far faster than relying on income alone. It's not about spending beyond your means. It's about borrowing strategically to create more money, more opportunities, and more freedom. Today, we're breaking down exactly how the rich use debt and how you can apply the same principles to grow your own wealth, understanding the difference between good debt and bad debt. The first step the wealthy take is understanding that not all debt is created equal. Bad debt is consumer debt, credit cards, car loans, or spending on items that lose value over time. Good debt, on the other hand, is used to acquire assets that generate income or appreciate in value. Real estate loans, business financing, or investments in education can all fall into the good category. Rich people treat debt like a scalpel, not a hammer. They borrow to build, not to consume, ensuring that every dollar borrowed has the potential to return more than it costs. This mindset alone separates millionaires from everyone else living paycheck to paycheck. Leveraging debt to acquire real estate. One of the most common ways the wealthy use debt is through real estate. Instead of buying a property with cash, they secure loans that allow them to purchase more valuable assets than they could otherwise afford. The key here is leverage, using borrowed money to control assets that generate rental income, appreciation, or both. A $100,000 property might produce $1,000 a month in rent. If you bought it with your own money, your return is limited to that cash investment. But if you finance it with a 20% down payment, you're now controlling a $100,000 asset with only $20,000, multiplying your potential returns. Debt, when managed wisely, becomes a wealth-building accelerator. Investing in businesses using borrowed capital. The rich don't just buy assets, they build or invest in businesses, and they often use debt to fund these ventures. Instead of using all personal capital, they obtain loans or lines of credit to scale operations, hire talent, or expand into new markets. This approach allows them to capture larger opportunities without risking their entire savings. By leveraging other people's money, banks, investors, or strategic partners, they amplify potential returns. The key is that the business generates more profit than the cost of the debt, creating a net positive cash flow while building equity in the company. Tax advantages of strategic debt. One reason the wealthy use debt is because of tax efficiency. Interest on certain types of loans, like business loans or mortgage interest, can often be deducted from taxable income. This reduces the real cost of borrowing and enhances the return on investment. While the average person avoids debt to dodge interest payments, the wealthy embrace it for its strategic benefits. Using debt in the right way lowers taxes legally, increases liquidity, and creates a system where borrowed money essentially works for them instead of against them. Debt as a tool for opportunity. Wealthy individuals use debt to act quickly on opportunities that others cannot. Imagine a real estate property comes on the market below value, or a business opportunity arises that requires quick capital. Those with cash alone may hesitate, waiting to save up, while those with access to credit can move immediately. Debt becomes a tool for speed, allowing the rich to act decisively while others are constrained by their limited funds. Opportunity favors the prepared, and in this case, preparation often means having borrowing power ready when it counts most. Using low-interest debt to maximize returns. Not all debt is equal, and the wealthy understand the importance of low-interest borrowing. By securing loans with low rates, they reduce the cost of leverage and improve profit margins. A low-interest loan on a property generating high rental income or a business generating profits effectively allows them to earn more than they pay in interest. This margin between the cost of debt and the income generated becomes a key component of wealth accumulation. It's not just about borrowing, it's about borrowing smartly. Debt builds credit and unlocks more opportunities. Using debt responsibly also strengthens creditworthiness, creating a positive cycle. Banks and financial institutions reward responsible borrowing with higher limits and better terms. The wealthy use this to their advantage, leveraging improved credit scores to access larger loans and more lucrative opportunities. Each responsible borrowing and repayment strengthens financial credibility, allowing them to take on bigger deals in the future. In essence, debt becomes a ladder. Each rung climbed opens access to higher wealth-building opportunities, protecting wealth while borrowing. The wealthy are careful to protect their assets while using debt. They structure deals and loans to minimize risk, often using corporations, limited liability entities, or trusts to separate personal assets from borrowed capital. This ensures that if an investment fails, it does not wipe out personal wealth. Most people overlook this step, thinking debt is inherently dangerous. The rich treat it like a calculated risk, where potential reward is high and downside is limited. Risk management is as important as opportunity when building wealth with debt. Debt multiplies when combined with compounding. Another reason debt can accelerate wealth is the principle of compounding. Borrowed money can generate returns that grow over time, exponentially increasing wealth. For example, a leveraged investment in real estate can produce rental income, appreciation, and tax benefits, all of which compound year after year. The cost of the debt remains fixed or even decreases in real terms if interest rates are low, while returns on the investment continue to grow. The wealthy understand this principle intuitively. Debt allows them to magnify compounding effects, turning small investments into substantial fortunes over time. Avoiding emotional decisions with debt. One hidden benefit of using debt strategically is that it disciplines decision-making. When the rich borrow money to invest, they are forced to carefully calculate potential returns, interest costs, and exit strategies. They cannot afford to act on impulse. This contrasts sharply with consumer debt, which is often emotional, impulsive, and destructive. By using debt as a disciplined tool, they maintain rationality in investing, ensuring each borrowed dollar works harder than a dollar earned and spent impulsively. Debt enables diversification. Borrowing allows the wealthy to diversify investments across multiple asset classes, real estate, stocks, businesses, commodities, and more, without tying up all their capital. Diversification reduces risk and increases the probability of overall gains. For example, instead of buying one property with cash, borrowing lets them acquire multiple properties, spreading risk and multiplying returns. The strategic use of debt turns limited personal capital into a diversified investment portfolio, which is a cornerstone of financial resilience and wealth accumulation. Learning to borrow like the rich. The final secret is mindset. Most people fear debt because of past experiences or cultural narratives. The wealthy approach it differently. They see borrowing as a calculated, strategic tool rather than a trap. They study terms, interest rates, repayment schedules, and market conditions. They surround themselves with advisors and mentors who guide decisions. Most importantly, they treat borrowed money with respect, always ensuring that the investment will generate more value than the debt costs. This disciplined approach separates wealth builders from debt victims, using debt to scale without sacrificing control. One of the most powerful ways the rich use debt is to scale their businesses or investments without giving up ownership or control. Unlike equity financing, which often requires giving a percentage of the company or asset to investors, debt allows them to access large sums of capital while retaining full decision-making power. This means they can expand operations, acquire more properties, or invest in larger projects without compromising their vision or control over the direction of the venture. It also ensures that profits and equity growth remain theirs to reap in full. By using debt strategically, they multiply their impact and accelerate growth while keeping the reins firmly in their own hands, a freedom most people never realize is possible when borrowing. Debt, when misunderstood, can destroy lives. But when used intelligently, strategically, and responsibly, it becomes a powerful engine for wealth creation. The rich don't rely solely on savings or income. They leverage debt to acquire assets, invest in businesses, act on opportunities, and magnify compounding returns. They protect themselves with structure and diversification. They discipline their decisions, and they understand the importance of low-interest borrowing. The key takeaway is simple. Debt is not inherently bad. It's how you use it that determines whether it will be a liability or the fastest path to financial freedom. By reframing your perspective on debt, embracing it as a tool rather than a burden, and learning to borrow responsibly, you can harness the same strategies the wealthy use to build lasting wealth. Understanding leverage, risk, compounding, and strategy gives you the power to accelerate financial growth far beyond what savings alone can achieve. Debt isn't the enemy, it's the hidden weapon of the financially successful.